Hey everybody, welcome back to Drawbridge Finance. My name is Levi Woods and I am approaching my 24th year of investing. I can't believe how much time has flown since I made my first investment when I was 16 years old. And I've been thinking a lot about time and the passage of it, and I've been thinking about how my investment strategy now is completely different to the investing strategy that I was using when I was very, very young. And I was thinking that if I had a time machine, if I could travel back in time to talk to myself, what kind of advice would I give myself to shape my future that I have now? Now, I've done all right for myself. I have a beautiful home in a very expensive city. I am a month away from officially 100% calling it quits and not working or not having to work another day in my life. And that is an amazing feeling. Now, that said, I love my work. If you guys aren't familiar with it, I just spent the entire weekend building some absolutely amazing weapons for a ridiculous feature film that's shooting here in Vancouver. I wish I could show you guys some pictures, but of course my non-disclosure agreements don't allow me to do that. But I assure you, when you see the movie, you'll be like, wow, that is some pretty cool stuff you built, Levi. Anyways, enough of that. Today I want to talk about the type of investing that I did when I was 18 and the type of investing that I do now, and how somebody that is only 18 now or very young in their early 20s could take advantage of the knowledge that I have now to apply a really great investment strategy. All right, well, I hope you guys enjoyed that ridiculously long intro. It is super rainy today. I'm taking a rest day at home because, as I said, I was working on these weapons. My hands are a little bit sore today from all of the physical work that I'm doing, and I'm trying to make a bit of money using my brain instead of my hands. And that's one of the things that's amazing about investing. If we delve into the numbers, if we play this silly game that is the stock market, and we play statistical probability, we know that over time we can build wealth. And you have to have an interest for that. I have an interest in money and in numbers, and I really, really enjoy doing it. And I know that that's not for everybody. And so today, what I'm going to do is I'm going to talk about how somebody that doesn't have an interest in investing can actually make money in a very similar way that I do. So today, the first thing we're going to look at is some of the options that closed last Friday. So I'm going to pull up a chart here because one of the things that I do primarily as a trader now, I'm a long-term dividend investor. So I have buy and hold stocks. Those stocks are building dividend revenue all the time. And I say revenue because it's income generating revenue. So I get cash every single month that I hold the stocks. I can use that cash to either live on or reinvest or do whatever I want with it. And that's the type of long-term strategy that I've taken, and it has done very, very well for me. But in the last couple of years, I've been just increasingly interested in trading. And with the stock price valuations, stocks themselves are actually really difficult to try to make money off of trading. So what I have done is I've kind of switched gears. I'm using leveraged funds, basically. I'm using my money to buy and sell options. And options are contracts that are on an underlying of some sort. So we can buy an options contract or we can sell an options contract. We could sell that on a particular stock, or we could sell it on an ETF. So one of the things that I like to do is sell on the ETFs, and I'm going to show you a couple of those today, and I'm going to show you some specific stocks. Now, what happens with these strategies, people have been asking me to do more videos on options because they like my approach and they think that I explain things really well. So I hope this isn't super confusing. I am going to rush through this today. If you have questions that are specific, leave them in the comments below. But let's just take a look at what exactly happened, and you can see kind of my thought process. So the first one that we're going to look at is a Costco option. Original transaction happened back September 11th of 2019. So just a month and a half ago. At that time, Costco was trading for $293.27. And now I wanted to put on a position where I sold premium and I collected money. So I'm going to sell an upper limit call and I'm going to sell a lower limit put. And then I'm going to buy protective call even higher, and I'm going to buy a protective put even lower. So I'm buying some positions, selling some positions, and then buying some other positions. That way I can collect some premium if the stock doesn't move too much. And that's kind of the idea with this, is we look at the ranges and we can see if the stocks move or not. So in this particular case, here's the breakdown of what I did. So that, remember, the stock was trading at 293. So the lower positions I bought, and these are the protective ones, I bought some puts for 270. Then I sold some 275 puts. So there's a $5 difference here, and that $5 difference equates to $500 of capital risk. This 270 position protects this 275 position. So if the stock goes way down, the most I can lose on this trade is $500. What happens if the stock goes up? Well, it's trading at 293. My upper limit is going to be the call. So I'm going to sell a call at 315, and I'm going to buy a call at 320. So again, this $5 difference on 100 shares works out to a $500 difference. Now for that, I collect a little bit of premium. So the purchase price of the puts for 270 was $2.46. Then I sold the 275 puts for $3.31. And then I sold some calls for $1.57, and I bought my protective calls for 98 cents. That's kind of the core strategy. That's an iron condor. So I've got a maximum $500 loss if the stock goes down. I've got a maximum $500 loss if the stock goes up. And for that, I collect $1.44 times 100 shares. So I have a profit range of $144. And all this Costco stock has to do is stay between 275 and 315. I mean, that's a pretty big, wide gap. There's $40 difference in there. So what happened? Well, we held on. The stock moved up and down inside that range, and it stayed within the range the entire time. So eventually what happens is all of these options, the calls, doesn't matter if they're bought or sold, and the puts, doesn't matter if they're sold or bought, they all expire worthless. So because the stock was trading at $302.96, which is right in the middle of those strikes, all of those options were worthless. Didn't matter if I was long them or short them, they're all worth zero. So they literally just expire, and I keep the cash that I originally collected. Let me just go through the details. I held the transaction for a total of 37 days. Now, the amount of capital that I had to put up per contract was $1,900 American. Now, every platform calculates this differently. Theoretically, there really should only be $500 in risk here. So the margin, in theory, is only $500. But everybody's account calculates slightly different, and that's to do with your broker. So this is what my broker charges me. I'm a Canadian, so there's all sorts of weird rules. But $1,900 is the amount of money that I had to allocate towards this trade. So my return was $144. I've risked $500, I've made $144, used $1,900 in margin. So my return on investment, $144 from this $1,900 that was earmarked, never spent, just earmarked, is 7.6%. And that's in 37 days. So when we do the math, it's a 74% return annually. And you can see that this is how investment funds make huge amounts of money. They take plays like this and they make massive amounts of money every single month. So now I'm going to just quickly go through a gold one. Similar setup. So GLD is the ticker. September 13th, the price was $140.86. This time I didn't buy protection. I just sold the puts a 135 and I sold the calls 147. It's called a strangle. It takes a little bit more buying power, but I have no debit in this one. In the Costco, I had these positions that were debits. This one, I only have credits. So I collected 29 cents and 77 cents for a total credit of $1.06. Gold barely even moved. Look, it was trading at 140.86. It actually went down to 140.46, and it only needed to stay between 135 and 147. I held it for 35 days. The margin contract was a lot because this is naked. There's no protection, so it cost me a lot more money to buy, $3,500. But I made $106 off that $3,500, which is a 3% return, or 31.6%. Now, the interesting thing is if you look at the value here, even though these are dramatically different, I actually collected very similar money. I made 7.6% return on Costco, or $144, and on GLD I made $106. And this is per contract. So if you open up multiple contracts, you can get more money just by scaling up a little bit. Then the Qs, I'm going to just blast through this, but basically I opened a position. It was an iron condor, $5 wide spread on the bottom on these puts, and a $5 wide spread on the top with these calls, the 197-202. Now, the stock actually moved down quite a lot. It moved down to 184, and I made an adjustment to this position on October 2nd, and that ended up costing me a little bit of money. Had I held to expiration and just not adjusted my original trade, would have made $1.14 or $114. But instead, I actually only collected $50 from this trade, which was a 6% return and 88% annually. Now, the SPY trade, one side was way out of the money right away, so I bought it to close. So there was a little bit of management. This management worked quite well. So I got out 4 cents on this particular trade when I bought the call out because the stock price had dropped down so much. But effectively, originally I collected $1.19. I bought back a little bit, 4 cents worth. And so my total profit was $115 on a $2,800 investment, or a 71% return annually. In 1 month, you can see 37 days, 35 days, 25 days, and 21 days. And they're huge gains. Now, I don't want you to think that, oh, these are all winners. They definitely are not. These are the ones that were winners, and that's why I let them run to expiration. The losers, I actually closed early. So if we look month over month, a typical gain for my account is anywhere between like 2 and 4% per month. So these numbers are a little bit skewed to the high side because these are the ones that just expired just on Friday. So in this next cycle, in the November expiration, I'm going to be opening up similar trades. In fact, I've just opened up a GLD trade this morning, and it's very similar setup. You can see the details on my Patreon account. If you guys are interested in becoming a patron, you can see all of my trades. But that's not what this video is about today. Today, I want to show you guys how to actually take this style of trading and apply it to a portfolio without actually doing the trades yourself, because that way you can make some money and you don't have to rely on actually doing the research, spending the time, and all of those things, because time is money. And especially for young traders, you may have a very small account and you want to actually be able to make money without having to do these transactions. So I'm going to introduce you to somebody if you don't already know him. He is the 3rd richest person in the world. It's Warren Buffett. Now, Warren Buffett has been investing since he was in his 20s. He was a billionaire by the time he was 30. He is absolutely one of the world's best, probably the world's best investor ever. And if you don't know him, he is amazing. Anyways, he's a long-term dividend investor, and he always talks about that, collecting dividends, how he'll never sell a share of Coke. He just reaps the benefits of collecting the dividend off of it. But what he very rarely talks about, and what his company does a lot of, is they sell options. They buy and sell options. And this is something that is available to us retail investors, because somebody like Warren surrounds himself with smart people. He has built this giant business. They make billions of dollars, literally, and they allow us to invest in the company. Now, of course, you're thinking, well, I can't afford that. Like, how much is this stock worth? Well, let's just take a look. Berkshire Hathaway, here's the BRK A class shares. They are currently $316,000 a share. Now, that is pocket change for some people, but that's a little bit too rich for my blood. Now, I don't know many people that have Berkshire Hathaway shares. I actually do know a couple people that do have some. I personally don't have any of these BRK A-class shares, but I do have some of the B-class shares, and I'm going to take a look at those right now. Let's take a look at this chart, and you can see that it's currently trading at $210. Now that's way more affordable. $210 US, I think I can afford that. And look at this crazy chart. Now I've got this scaled out to back to when I started investing. Now I made my biggest mistake investing when I was 18. I stupidly went to the bank and trusted some financial advisor there that knew nothing. I knew that I needed to invest my money. I took out a loan so that I could invest my money into an RSP, which was a very smart choice. I still would do that today. If I had no money, I would take an RSP out, or an RSP loan, because they work really well for Canadians to allow us to be able to invest when we don't have any money. I paid back that loan. But where I failed was I invested in the wrong thing. I invested in a mutual fund with the bank. So the bank made money off me and I made no money. Now, I did that for 5 years. I gave my money to the bank, and when I was 23, I finally got a financial advisor who was actually able to help me. He got me on the road to dividend investing, and my interest in dividend stocks is what eventually led me to option trading. Now that I know what I know, if I could go back in time and say to my 18-year-old self, this is what you should do, I would absolutely be saying, buy Berkshire Hathaway shares. I'm just going to show you guys the power of what these shares have done. So let's just look at this chart quickly. I'm going to go back to the very end of 1997, where we could buy shares around $31. I'm just going to load up an app on my phone and just look at what a return on investment is. $31 that turns into $210 over 22 years. The simple annualized return is 26% per year. Compounding, it's 9.09%. Now, this is buying one stock that at the time was $31. If I had invested my $2,000 back then, it would be worth over $13,000 today. If I had continued to invest $200 a month from when I was 18 till today, I would have almost $200,000 in my account in one company that buys and holds dividend stocks, and they buy and hold options. So they can take that money and give it back to their shareholders. It is unbelievable. This is why today I still hold Berkshire Hathaway Class B shares in my own portfolio. I know that going forward, this company is going to make a huge impact in my overall portfolio. And I don't have to do anything. I just have to sit back and purchase shares at a regular interval. Anyways, that's it for today's video. I hope that was insightful to you guys. I hope you learned something. If you're interested in following my trades, check out my Patreon account. If you love the information that I shared, please consider subscribing and share this video with your friends, because I want to get rich with everyone. Let's get rich together. See you very soon.